In the first quarter of 2026, Naver's reported net profit plummeted 32.8% year-over-year. South Korea's tech ecosystem looked like an engine rapidly losing compression. That single metric was enough to trigger a severe repricing across the market. Institutional investors quickly applied a heavy discount to the stock, labeling Naver a stalled holding company carrying too much dead weight. Two specific fears drove this sell-off. First, the assertion that generative AI is finally dismantling Naver's search monopoly. Second, the belief that poorly performing subsidiaries are permanently dragging down the intrinsic value of the core business. But this split-screen chart contradicts the narrative. On the left, headline net profit plunges red. On the right, actual operating cash flow climbs. Notice the conversion ratio. Real cash entering the corporate treasury consistently sits between 130 and 140% of reported operating profit. Book profit is an accounting opinion. Cash in the bank is a fact. The market has conflated a temporary distortion on the balance sheet with a structural decline in the actual business. To expose this mispricing, we have to forensically deconstruct the Q1 financials and locate exactly where that drop came from. We can isolate the true health of the business by stripping away the non-operating noise, line by line. This waterfall chart breaks down the Q1 net income. We start at the baseline, the core operations. Naver generated 5,418 billion won in core operating profit. That is a 7.2% increase year-over-year. That growth metric alone proves the core ad tech and commerce segments are not shrinking. They are expanding and generating more capital than they did a year ago. The first sign of trouble appears entirely outside of Naver's direct operations. We see a massive deduction of 1,315 billion won recorded as an equity loss connected to their stake in Line Yahoo. But an equity loss on a financial statement does not automatically equal cash leaving the business. This specific deduction is a valuation swing based on accounting rules for joint ventures. In reality, official disclosures show the actual book value of Naver's Line Yahoo stake increased by over 5,300 billion won during this period. There is no structural impairment to the asset itself, merely a required markdown on the quarterly income statement. The second deduction hitting the bottom line is labeled simply as other expenses, dragging net income down by an additional 1,271 billion won. This leads us directly to the heavily publicized 32.8% contraction. Digging into that category, we find a 1,552 billion won block of miscellaneous costs that remains unclarified in the public filings. This exact line item is the primary variable of uncertainty in any accurate valuation model of the company today. The valuation math now hinges on a single binary question. Are these unclarified expenses a one-off accounting event or a recurring structural drag on the company's margins? The narrative of a business in rapid decline is an illusion built on holding company accounting rules. The equity swings reflect an opinion of peripheral assets, while the 7.2% operating profit growth reflects the cold, hard reality of Naver's cash flow. The accounting noise only explains the subsidiary fears. We still have to address the primary bear thesis driving the market, the assumption that conversational AI is cannibalizing Naver's search volume, threatening the very root of its ad revenue. The fear is grounded in consumer survey data. By early 2026, ChatGPT had surged to 54.5% as a primary information channel for early adopters, and Gemini adoption had nearly tripled. But survey preferences do not always translate into mass behavioral shifts. To see the actual impact on Naver's ad infrastructure, we have to map the empirical domestic search data. This timeline charts Naver's domestic search share. After facing moderate pressure early in the year, Naver deployed its native AI search tab in beta on April 27, 2026. Rather than bleeding users to standalone AI platforms, Naver's market share rebounded aggressively. Less than a month later, on May 24th, Naver secured 81.3% of the domestic market, rendering Google a distant minority at 14.9%. Naver insulated its traffic not because it has a regulatory monopoly, but because it operates a deeply entrenched ecosystem. The cost of switching away from Naver is simply too high for the average Korean consumer. The mechanics are straightforward. A single user ID seamlessly binds search results to Naver Shopping. automatically connects to Naver Pay for checkout, and ties into digital content like Webtoon. If a user wants to switch search providers to use a different AI chatbot, they have to abandon a highly integrated commercial, logistical, and financial ecosystem. By tying search directly to daily commerce, Naver built a structural defense that standalone AI tools struggle to penetrate. We have an intact, growing core business, protected by a heavy ecosystem moat. Now we compare that reality to the $31.4 trillion valuation the market has placed on the stock. To justify a price that low, we have to reverse engineer the math and look at exactly what institutional investors are modeling for the company's future. This chart reveals the market's assumption. Investors have taken the Q1 accounting noise and projected it forward as a permanent condition, implying a functionally stagnant net income of just 1,745 billion won, all the way out to 2028. But if we strip out the temporary equity markdowns and rely on the actual cash trajectories of the core business, we generate a highly distinct base case model. This model relies on two conservative conditions: the line Yahoo equity swings normalizing back to zero, and the core operations maintaining a 15% organic growth rate driven by ad tech and commerce. If those two basic conditions are met, the normalization target yields a 2028 net income of 2,100 billion won. When you map that normalized cash flow onto a standard earnings multiple, adjusted for Naver sector, you arrive at an intrinsic equity value of roughly 37.7 trillion won. The entire market is currently pricing Naver on a worst-case scenario of indefinite stagnation. By trading strictly on headline noise rather than operating cash, the market is offering a structural 17% margin of safety against the business's baseline reality. Spotting a valuation gap isn't enough. You have to identify the specific catalyst, the exact data point that will force the broader market to wake up and reprice the entire asset. That immediate gateway is the Q2 earnings report, scheduled for July 31st. So the gap to close, that report must deliver two specific metrics: proof that the line Yahoo equity swing has reversed to a positive contribution, and final clarity confirming that the massive block of other expenses was in fact a one-off event. Beyond July, the calendar is packed with secondary catalysts. Sovereign AI infrastructure contracts are moving toward the deployment stage, and the antitrust review for the integration of the crypto exchange Dunamu targets a September 30th resolution. None of these second-half catalysts are factored into our 2,100 billion won base case. They represent pure, unpriced upside that the current market capitalization ignores entirely. And if the Q2 numbers fail to normalize, the floor is fiercely protected. Naver holds roughly 4.5 trillion won in pure net cash, a massive liquidity shield actively buffering the balance sheet against worst-case scenarios. Right now, Naver is a highly defended, cash-generating engine trapped beneath a temporary accounting illusion. Until the July 31st data confirms the end of these equity distortions, the asset remains one of the highest conviction watchlist targets for anyone capable of analyzing the cash beneath the noise.